Hi, welcome to the Augmented Equity. The recent tension between the US and Iran has the markets all over the place. To help navigate the chaos, I've been looking closely at the VIX. It's famously known as the fear gauge, and it's a perfect tool for measuring just how much panic is actually baked into the market right now. Hope this helps. Let me know your thoughts on the VIX in the comments, and tell me what you want to see covered next on the channel.
You know, the stock market, it has a heartbeat. And right now, you can probably feel it racing. So if you're tired of just reacting to scary headlines and you want to start making some smart, data-driven decisions, you've got to understand that pulse. Today, we're going to decode the market's fear gauge, the VIX, and I'm going to show you exactly how to turn all that market panic into your own personal playbook. Look, if you've glanced at your portfolio recently, I'm sure you've felt that knot in your stomach as those red numbers start to pile up. It's a totally normal feeling. But what if I told you that while you're watching those prices drop, the smartest people in the room are watching something else entirely? Let's just break this down. Well, pretty much everyone else is glued to their screen, just watching their portfolio shrink. The pros are focused on a completely different metric. They're not just looking at a price chart, they're looking at the VIX. And that's the key shift we're going to make today. We're going to stop watching the symptom, which is the price drop, and start diagnosing the cause, which is the fear itself. All right, so let's pull out our diagnostic tool. What exactly is this thing that the pros are so obsessed with? Okay, so in simple terms, the VIX is just a number that shows how much Wall Street thinks the S&P 500 is going to swing over the next 30 days. The key here is that it's not looking at the past, it's a forecast. And it gets all this information by tracking the price of options, which, believe me, is the secret sauce to how this whole thing works. And this is a brilliant way to think about it. Just imagine the VIX is the price of market insurance. Okay, so first, when the big institutions, the smart money, when they think a storm is coming, they rush to protect their huge portfolios. How do they do that? Well, step 2, they buy put options, which are basically just insurance policies against a market crash. Third, just like hurricane insurance gets crazy expensive right before the storm hits, these options get way, way more expensive when the market gets nervous. And finally, the VIX is really just calculating those rising insurance prices in real time. So more fear means higher insurance costs, which means a higher VIX. It's really as simple as that. Okay, so now that we know what it is, let's figure out how to actually read it. To use the VIX right, you've got to treat it like a thermometer for the market's overall health. This table lays out the market's different moods perfectly. When the VIX is below 15, we're in what you'd call complacency. Yeah, stocks are kind of grinding higher, but it's dangerous because almost no one is ready for a shock. The 15 to 25 range, that's the market's normal, healthy zone. Then, from 25 to 35, we get into high stress. This is where the market swings on every single headline. And above 40, whoa, that is full-blown panic mode, when extreme fear has totally taken over. And just to put this into context for you, as of mid-March 2026, the VIX is sitting right here at 2685. You see that? We are smack in the middle of that high-stress zone. So this isn't some abstract theory. This is the live temperature of the market right now. So we've diagnosed the current condition. But what's the prognosis? Well, here's the cool part. History shows us that market panic isn't random. It actually follows a really predictable pattern. The most important concept you need to grasp is that the VIX is mean reverting. Now, unlike a stock that can go up forever or drop to zero, the VIX always wants to return to its long-term average, which is right around 19. Think of a VIX spike like a stretched rubber band. It just can't stay stretched out forever. Eventually, it has to snap back. And this timeline just proves the point. I mean, look at these moments of absolute crisis. In the 2008 financial crisis, the VIX shot up to 80. During the 2020 pandemic, it hit 82. Even during the 2025 Tariff Shock, it jumped to 52. And in every single one of these cases, no matter how terrifying the headlines were, the VIX eventually fell right back towards its average. Panic is always temporary. And all of this history leads to one of the most powerful rules in all of finance. That moment of peak VIX, the point of maximum fear when literally everyone is selling, that has historically been the signal that the market bottom is either here or very, very close. The selling just gets exhausted and a reversal tends to follow. Okay, so we get the diagnosis, we understand the prognosis. Now it's time for the treatment plan. how do we turn all this knowledge into an actual, actionable strategy? So let me show you a really simple piece of math that the pros use every single day to stay rational while everyone else is panicking. It's called the Rule of 16. Let's just say you wake up one morning, you check the news, and the VIX is sitting at 32. Okay, that feels pretty scary, right? But what does that number actually mean for today? It's this simple. You just take that VIX level, 32, and you divide it by 16. That gives you 2. What does that mean? It means the market is mathematically expecting a 2% move today, either up or down. A 2% swing is already priced in as just a normal day when the VIX is at this level. So let's ask the question then. If the market is already priced for a 2% move and your portfolio happens to be down 1.5%, is that really a reason to panic? Absolutely not. In fact, it's actually a quieter day than expected. This simple math helps you tell the difference between real danger and just normal high volatility noise. And this all feeds right into that old floor trader mantra. It's all about being a contrarian. When the VIX is screaming with fear, that rubber band is stretched to its limit, and it's probably going to snap back, pulling the market up with it. On the flip side, when the VIX is super low and everyone's feeling great, the market is actually really vulnerable to a sudden shock. Now, a really common question I get is, how do you apply this medicine? Do you use a VIX spike to buy the whole market, or do you use it to buy that one specific stock you love? Well, the answer is a little bit nuanced. You see, for broad market ETFs, like SPY, the VIX is an almost perfect inverse indicator. A huge VIX spike is a powerful signal that the entire market is oversold. But for single stocks, it's a bit riskier. An individual company can have its own terrible news, like a horrible earnings report, that has absolutely nothing to do with the overall market panic. That's what we call company-specific risk. But here's the pro strategy that kind of blends both of these ideas. First, you wait for that huge VIX spike, that moment of pure market-wide panic. Then, you use that opportunity to buy shares in great blue-chip companies that are just being sold off unfairly. You know the saying, they're being thrown out with the bathwater. This panic gives you a fantastic chance to buy a great company at a discount. So let's bring it all home. The whole goal here is to stop trading the emotional drama you see in the headlines and start trading the objective math of the VIX. And remember, this is the most important point. The VIX is not a crystal ball. It has no idea what's going to happen tomorrow. What it does, with incredible accuracy, is tell you the exact temperature of fear in the market right now. And knowing that temperature, well, that's your greatest advantage. Every single day, the VIX is out there telling a story about fear, about complacency, and about opportunity. Now that you know the language, the only question left is, are you ready to listen?